when you go to try and apples to apples compare across the entire credit market, not just private credit, in terms of default rates, you might well be looking at different events that are getting counted within those default rates. Covenant defaults, amendments to avoid covenant defaults, payment defaults everybody would have, and bankruptcy processes would be four broad categories. So there's some differences in the data. Then you go into the data set, where in private credit, particularly in the core middle market and below, these loans are closely held. There may only be one or two lenders holding the entire facility. And a lot of that data doesn't get reported, and very rarely are those loans rated in a traditional sense. So it's a tough thing to look at. What I guide investors towards is usually looking at, especially when they're looking at track records and trying to parse historical default rates, to instead look at losses. Because losses can't be manipulated. It doesn't matter how loose or tight the market documents are. Losses are really where rubber hits the road, and you can discern a manager's quality in their credit process.